Hello, welcome to our quarterly economic event. Thank you to our sponsors, James Cowper Kreston, based in the Thames Valley with offices in Reading, Oxford, Newbury, London and Southampton, who have kindly sponsored today's event and our quarterly economic survey. James Cowper Kreston delivered tailored accounting, tax and advisory services designed to support you, your family and your business. Today's session is unique in as we refer to our last survey, which concluded in September, and we start our next survey today and consider trading conditions and the wider economy in this post-budget world, and of course, following a base rate cut just the other week. But this is also a call to arms to ask you to complete the new survey today. I'm joined today by Sue Staunton, Joint Managing Director of James Cowper Kreston. Sue has a wealth of experience working throughout the industry with James Cowper Kreston for 20 years. I welcome back an old friend, Stuart Morrison, Head of Research at British Chamber of Commerce, and I'm joined by Robert Devine. Bob is a highly experienced investment consultant with a long history in markets, banking, and an asset manager in the city. Please let me start by handing you over to Stuart Morrison from the British Chamber of Commerce, who is going to reflect on the national picture through our quarterly economic survey. Stuart, good day. Welcome.
Thanks, Tim. Yes, I'm going to have the opportunity today just to talk you through the findings from quarter three. I'll just pop up some slides, if that's okay. And yes, as Tim mentioned, it's an opportunity to look back at the findings we had from quarter three earlier this year, and a good opportunity for you to look at these results, reflect, does that represent your business? Is that how you are finding trading conditions at the moment? And if so, to contribute your current views to the Q4 Quarterly Economic Survey, and if not, even more reason for you to take part in the survey and make sure that your voice is heard at the national level. So yeah, my name is Stuart Morrison, Research Manager at the British Chambers of Commerce. We act as the collective voice for all the chambers around the UK, including here in Thames Valley. So the Quarterly Economic Survey for Q3 took place between August and September. So this was a survey that took place prior to the budget and gives us a great insight into how businesses were feeling in the run-up to that budget. Which means when we compare this data to the findings from Q4, we'll get a great idea of what impact the budget has had on business sentiment up and down the UK. So we've got around 5,000 participants from a range of different sectors and sizes, and we're going to be looking at a range of indicators telling us how they were feeling back in August and September of this year. The main summary could be described as looking at the start of the year when we saw general improvements to business conditions and business confidence. Q3 really saw the first leveling off of that general improvement, and that's across sales, exporting, and investments. But in particular, we saw the manufacturing sector struggling a little bit more than we had seen at the start of the year. Also important to flag that we saw taxation rising as a concern for businesses. And these are some of the points we'll look at in a little bit more detail in this short presentation. So first up, we can look at our sort of key indicators, looking at both domestic and export sales. And you can see on the left-hand side of the slide that looks particularly at domestic sales has seen a leveling off of the red line, which indicates service sector sales, and quite a sharp decline for the black line that looks at manufacturing. And if we look at the chart on the right-hand side that represents export sales, you can see that both of those lines have declined in quite a pronounced way after having had quite a good start to the year over Q1 and Q2. Part of the reason for that could be what's demonstrated in this slide, which is if we look over the past few years, really, the proportion of firms citing inflation as a concern has slowly started to decline. So back in 2022, there was an enormous proportion of firms in the up in 80% and beyond who were saying that inflation was really much more of a concern than it had been in prior quarters. That started to decline, and you can see this quarter it's way down at 46%, still high by historic standards, but nowhere near where it was just a few quarters ago. In the reverse of that, if you look at the orange bar at the top, you can see the taxation, i.e. the proportion of firms who are citing taxation as more of a concern than it was 3 months ago, is up at 48%. And if you look back over the years prior, it's at around 30-odd%, up to 38% at some points, but generally considerably lower, and up to 48% now. If we think about when this survey took place, it was in the lead up to the budget, where there was a lot of speculation about taxes coming down the line. The government at the time had made assurances that taxes on working people wouldn't come up, but there was lots of talk about budget shortfalls. So I think businesses were putting two and two together and thinking that, well, it looks like perhaps some taxation was going to fall on them. And as we saw in the budget then, subsequently, that was proven right. And it'll be very interesting in the Q4 survey to see if that concern about taxation goes up or goes down, depending on business response to the budget. Why it's so important is shown in this slide here. Many of you will have attended webinars like this before, and perhaps attended events where we've spoken about the QES results, and you'll have seen similar slides to this. Talking about investment every quarter, we really don't see a significant amount of change in that top line proportion of firms that are seeing their plans for investment over the past few months increase in blue, decrease in red, or remain constant in grey. And that 23% who've seen their investment plans increase has stayed pretty constant over the past few years. Where we have seen some change is under the surface, and you can see this slide splits out the chart by different sectors, and there is a lot of variation depending on the type of firm that we're looking at. Retail and wholesale, much less likely to be reporting increased investment compared to, say, manufacturers or those in the media and marketing industry. We also have seen lots of difficulties when it comes to firms getting the staff they need to grow. And that looks like it seems to be continuing at the present time. So a similar proportion to previous few quarters have attempted to recruit. So on the chart on the left-hand side, you can see that's at 56%, which has come down over the past 3 quarters from a high of around 62% at the start of the year. But if we look at the chart on the right, we can see the proportion of those firms who've tried to recruit reporting that they're facing difficulty doing so. Now, while that was down at about 66% at the start of the year, it has slowly creeped up to now about 76%. So I think it's important, as we talk about lots of different factors that are affecting businesses with regards to what's happened in the budget, interest rate cuts, and that sort of thing. I think it's important to keep at the front of your mind that lots of the things we've been talking about with regards to recruitment over the past few years are still ongoing, and businesses are still facing those problems on a day-to-day basis. Where some of the issues that we've seen over the last few years have started to ease is with regards to prices. So the chart on the left talks about whether or not firms expect the price of their good or service to increase over the next 3 months. And you can see that following that huge spike in 21 and 22, we have now eased off, and the line has gone relatively flat, indicating that there's no significant growth in the proportion of firms expecting their prices to increase. The chart on the right-hand side looks a little bit at where the pressures are coming from with regards to price increases. So looking at a few different areas and asking businesses, are they facing pressures to raise prices as a result of these things? And you can see the most significant one is the red bar, which looks at labor costs. So whereas a few years ago we were seeing enormous cost pressure from utilities, energy prices, and raw materials, that started to ease. And over the past few quarters, really, labor costs has emerged as the dominant cost pressure for businesses. You can see in the chart that it does vary depending on which sector you're looking at. For example, if you look at manufacturing, perhaps unsurprisingly, raw materials is still much more of a factor than other sectors. But generally speaking, across the board, it is labor costs that businesses are finding the biggest challenge in terms of cost pressures at the moment. All this feeds into how businesses are feeling and how confident they are about the future. So we asked businesses over the next 12 months, do you believe your turnover will improve, remain the same, or worsen? And you can see that despite the slow growth in the proportion of firms anticipating an improvement in their turnover since the start of the year. You can see at the start of the year around 56%, crept up to 58 in Q2. That's now declined again, so dropped back to that 56 we saw at the start of the year. So those improvements and the benefits that businesses were seeing to more economic stability at the start of the year has dropped back a little bit because of what we've talked through in this slide, the concerns about taxation, the recruitment difficulty, and the lack of investment. So I appreciate that's been a relatively whirlwind tour through the data, but hopefully that's given you a really good snapshot into where the data that you submit as part of the QES goes. It gets fed into this overall national survey, gives us an enormous amount of information about what's happening in the UK economy, and we feed that into all the advocacy work we do, whether it's speaking to the Bank of England, to the Treasury ahead of the budget, and also to participating in consultation to the governments running on important issues for businesses like yourselves, such as on the industrial strategy that's coming up at the moment. All this data feeds into that and allows us to talk with confidence about what's happening to businesses up and down the UK and in the Thames Valley as well. I'll pass back to Tim. Thanks very much.
Thank you so much. Thank you very much. It'd be very interesting to read about, after the next survey, about businesses' price expectations and that confidence level as well. Thank you for that. Next, I'm going to hand you over to Sue Staunton from James Cowper Kreston, who's going to look more specifically at some of the local pictures that we've seen from the survey and going forward across Swindon and the Thames Valley. Sue, I'll hand over to you.
Many thanks, Tim. Many thanks. So I think the picture in the Thames Valley pretty much mirrors the trends that we're seeing on a more nationwide perspective, just with a few other sort of subtleties around it. So whilst as Stuart was saying, number of people, companies trying to recruit in Thames Valley, it's a little bit higher in terms of seeking to recruit, and a little bit lower in terms of difficulties in terms of recruitment, which is interesting. So what we're seeing is sort of a little bit more mobility perhaps in terms of staffing, as per the timing that the survey was taken. And of course, this was all pre-budget, and similarly to the national picture, the concerns of business very much articulated as being around tax and inflation, a much higher proportion around tax than previously. In fact, it's almost like a new entrant, I think, into the concerns that businesses have had. And this is, of course, in that interim period between the election and the budget actually becoming known. And it's quite interesting that we talk about relative business confidence coming into the budget as per the Q3 economic survey. But we immediately, as a firm, post-budget, did a seminar. And when we polled people attending the seminar, and there were about 400 doing that, business confidence was very low at that point. So 58% of people felt there was a decline in terms of confidence about what was going to happen in the future. And obviously, that's a snapshot taken immediately following the budget, where people were perhaps reeling a little bit from some of the announcements that have been made. But I think it would therefore be very interesting, as Stuart highlighted, to see what happens as regards the Q4 forecast survey. That it's really, really important, I think, that businesses do complete this and enable you to feed back into central government and policy, and also very important that is utilised as part of the consultation around the Green Paper on the industrial strategy that came out, I think it was on the 16th of October, to actually articulate what it is that businesses are feeling when they've actually had the opportunity to digest what's come out in the budget. So I think the Q4 economic survey is going to be really interesting, because it'll be a really good temperature change of what the impact upon business is actually going to be. I think one of the interesting things I said earlier in the Q3 survey was around staff and recruitment and difficulties in doing that. The same group of people that we polled immediately following the budget had not actually significantly changed their plans to recruit, despite a lot that's been more recently in the press around employers' national insurance and the impact of that upon the workforce. So again, it will be interesting once people have digested this to see what starts to happen, and also what the feedback will be in the QAS for Q4.
Sue, thank you very much indeed. I think it will be an interesting set of figures coming up. I think we need everybody to contribute. But let me hand over to Bob Devine. And Bob is going to talk us around. So we've heard about the budgetary headlines, but less so around the government's borrowing program. Bob, how could this affect inflation, interest rates, and sterling going forward? Over to Bob.
Yes, this is why it's important, because of the potential effect on inflation and interest rates. Just to go through some mechanics, the government borrows money by selling its debt in the financial markets via the gilt market. The DMO, Debt Management Office, a branch of the Treasury, auctions gilt issues throughout the year. Gilt-edged market makers, of which there are about 20, the four big UK investment banks, also the American investment banks, a couple of Canadians, a few European banks, Deutsche Bank, for example, some Asian banks as well, and Australian, are all gilt-edged market makers. They're invited to bid for the gilt auctions as they come out, and they then sell on to the investment institutions, such as pension funds, mutual funds, wealth managers, and so on. Now, already yields in the gilt market have risen substantially as a result of the announcement of this new borrowing requirement by the government. This is because the market obviously raises the risk level and looks for higher yields in order to compensate for the risk. This costs the government because they will have to issue gilt issues with a higher coupon than they would have otherwise had to, and pay more interest. So this brings in a couple of risks, and this is where the risks really are. That is, first, the potential that a gilt issue might be undersubscribed. Never happened. It might never happen, but it could happen. And if it does happen, it will have a hell of an effect on the market, on the currency, and on the gilt market. Yields will rise, affecting interest rates and so on. The other risk is the potential risk of default. Default risk. A lot of people will have heard of Argentina and so on in the past. The UK has never defaulted on its payments of interest on its debt, but as its debt rises to higher levels and its interest payments become larger, there is that risk, that default risk. And as a result of that default risk, the market will look again for higher return. So basically, all I'm saying is that this borrowing program poses huge risks to both inflation and interest rates that may play out or may not. I'm hearing at the moment that there is appetite in the market to buy more gilts. So at the moment, it would look to be relatively stable. But of course, throughout 2025, they will be launching and auctioning various gilt issues as they come down the stream. And the market is looking at the huge volume that could come through, which is why the yields have risen so much. So it is potentially risky to both inflation and interest rates. Already the Bank of England is suggesting in its inflation report that the inflation rate by the end of the year will have risen from about 1.5, where it is now, to around 2.5. And then you've got to go through 2025. So we will have to see how that plays out. The second thing I want to talk about is the government's pension reform program. Now, I actually agree with this wholeheartedly. We do want to see investment institutions investing more money in UK companies. The reason they don't And the reason why this has kind of developed over the last couple of decades, and particularly accelerated since Brexit, is purely and simply because institutions, pension funds, mutual funds, wealth managers, when they invest, when they set their asset allocation programs, they tend to look at them from the size of market perspective. Now, the UK stock exchange capitalization is far lower than the US, the EU combined, and the Asia combined. So they tend to invest more abroad these days than they do in the UK. If you look at an average portfolio, I mean, I advise a few charities on their investments, and if you look at a number of portfolios that are managed by wealth managers, they are allocated much outside the UK because the UK is now a very small market. So I agree with this pension reform, and I think that the investment institution should be encouraged to invest more in UK companies. I'm actually pushing it very much with the new investment policies that I'm helping to write for charities that I work with, that they should invest more in UK companies. So I wholeheartedly support it. And that's really basically all I've got to say, really.
Thank you very much indeed. That's perfect, Bob. Thank you ever so much.
You're welcome.
Well, that concludes. We've heard a lot today about the state of the market, state of business, and there really is an opportunity for everybody out there to participate. For those who are hearing perhaps for the first time around the industrial strategy, I know the British Chamber will look to drive that participation in the new year. And everybody, if you go to the government website, you'll find more details about how you can influence it. But if you don't want to do that, but you want to write some comments in the survey, which is online, you will find it, as they always say in popular videos, you'll find the link below. So I would ask you to participate fully. Just remains for me to thank everybody in the room, Stuart, Bob and Sue and James Cowper Kreston, for their great support to the Chamber. And most of all you out there in world of business, your participation is greatly appreciated, and I look forward to seeing you all very soon. Thank you. Goodbye.